Tesla is the leading electric vehicle manufacturer in the world. Its rise in the past 3 years has benefited the retail investors most, and Tesla stock has become the most beloved stock. In this video, we will look at the first quarter 2020 delivery numbers. We will also look at a few factors that will benefit the Tesla stock in 2021. In the end, we will also look at a couple of risk factors for the stock. 2020 has been a milestone year for the Tesla. It was the first ever profitable year in the history of the company. The company also had 2 capital raises. It offered its stock in the public markets and raised $19.5 billion of cash on the balance sheet. The growth of Tesla has been remarkable. It achieved a revenue growth of $208 million in 2011 to $31.5 billion in 2020. In the first quarter, Tesla produced almost 180,000 vehicles and has delivered 185,000 vehicles. The Model Y in China has been well received. The equipment for producing the Model S and X have been installed in the first quarter and they have been tested. The company is looking to ramp up production in the first quarter. Tesla is in the early stages of ramping up production. A lot of electric vehicle companies like GM, Ford, NIO and Xpeng have been hit by the semiconductor shortage across the world. Some of these companies have halted production. It is really impressive that despite these supply chain issues, Tesla is able to deliver record deliveries. Tesla semi-deliveries will also start in the later part of 2021. Tesla's shares have been trading in bear territory after the all-time highs reached in January 2021. The major resistance level for the Tesla stock is at $690, which is the 50 days EMA. The exceptional delivery numbers may provide the catalyst for Tesla to break through these resistance levels. Hi, my name is Arshad Ahmed. I'm a founder of DIYstockpicker.com, an investment portal dedicated to help investors make intelligent decisions. This video is for information purposes and please do your due diligence before making any investment decisions. Looking at the management guidance from the Tesla company, they are positive that they will be able to achieve 50% of deliveries growth year over year over a multi-year horizon. They have enough liquidity of $19.5 billion cash on balance sheet to fund their growth and expansion. The gigafactories in Berlin and Texas will soon start manufacturing the Model Y and the deliveries will start rolling out in the later part of 2021. Shanghai factory is churning out the vehicles at a faster pace and is expected to even further increase during the rest of 2021. For the year 2020, Tesla achieved an operating margin of around 7%, which is really impressive. As the electric vehicle batteries cost gets lower each day with advancement in technology, the operating margins are further expected to increase, which will fall to the bottom line of Tesla. President Biden unveiled the $2 trillion infrastructure plan and electric vehicle makers will benefit a lot from this. The current market share of electric vehicles in US is only 1/3 of the electric vehicle sales in China. The US wants to catch up with China in electric vehicles. President Biden is looking to make $174 billion of investment in the supply chain of electric vehicles as well as the charging infrastructure to catalyst this growth. There is already a federal tax credit of $7,500 for electric vehicles. But for manufacturers who have delivered more than 500,000 vehicles, this credit is not available currently. But the state governments incentivize the purchase of electric vehicles. Also, Wedbush analyst predicts that the federal credit would be increased to $10,000 for each electric vehicle purchased. The past week, ARK Invest has released a report valuing the Tesla stock at $3,000. This may seem ridiculous, but ARK Invest correctly predicted that the Tesla stock would trade at $800 back in 2018 when the stock was trading at $70 a share. The reason for this rich valuation is that they are betting on the delivery of autonomous vehicles by 2025. Tesla has been collecting a lot of data from its cameras and refining its machine learning algorithms and rolling out the updates for full self-driving. They expect that by 2025, Tesla vehicles will be fully autonomous and will capture a huge market share. Another reason for this valuation is that they are betting that Tesla will achieve cost effectiveness. With advances in battery technologies, the cost to produce vehicle keeps decreasing each day. They are betting that by 2025, Tesla will be producing 5 million vehicles. On their part, Tesla have delivered on each target they have set. In the year 2020, Tesla set a target of delivering 500,000 vehicles. Despite the pandemic and closing down of the factories, Tesla achieved this goal. This remarkable agility and commitment is what provides Tesla the rich valuation from ARK Invest, who are one of the biggest investors in the stock. As we know, Tesla not only produces electric vehicle cars, but it also produces solar panels for residential and commercial customers. Clean energy is a big part of the agenda of the current US government. The growth of Tesla Energy has been impressive. In the next couple of years, we will start seeing significant revenues from the Tesla Energy sector. There are, however, a couple of risk factors for Tesla. The first is that the SPAC mania recently has propelled many of the private EV companies and technology makers to go public using the SPAC route. There is now a plethora of companies manufacturing EV cars and commercial EV vehicles. Tesla will soon be facing competition from these companies. The current OEM manufacturers like Volkswagen, GM and Ford are soon catching up with Tesla. Volkswagen is betting to catch up with Tesla in a couple of years. It already produces about half the EV vehicles that Tesla delivers. GM has made significant investment in the electric vehicle technology. These legacy OEM companies were like big ships that are going in the ocean in one direction. It does take time to change the direction of the ship, but once they do that, they go ahead full steam. Another risk factor may be the economic outlook. The growing treasury yields recently have hammered the growth stocks. As the interest rates rise, the cost to borrow money increases. This severely affects the growth companies because their growth has been priced into the future and investors are paying today for the growth that comes about 5 to 10 years later. The treasury yields more interest rates. Investors look to move their money from the equities to the bonds. When investors can earn a safe return investing in bonds, the equities do not look interesting that much. The current boom for the growth stocks has been fueled by historically low interest rates. The cost to borrow money was significantly cheaper and there was no return investing in bonds. So investors were putting all their monies in growth stocks, thereby fueling their prices. The Federal Reserve has promised that for 2 years they will keep the interest rates low, but after that slowly they will be tapering off the financial support that they have been providing the system. Tesla on its part does not need to borrow any money to fuel its growth. It had 2 capital raises last year when its stock price was at all-time highs. This was a smart move by the management. Good capital allocation dictates that you raise money when the stock prices are higher, rather than issuing debt. This is something the Tesla investors need to be aware of, that the future growth will not be as exponential as in the past 3 years. I hope you found the video informational. I have analyzed the ABCL stock. You should see that here on the end screen and I hope to see you in that video. Thanks for watching.